Let me start with a thought experiment. When we talk about India's next big manufacturing story, most people jump straight to electronics, semiconductors, and maybe EVs. Very few people say textiles, and that's exactly why this is interesting. Because sometimes the biggest shifts don't come from flashy new sectors. They come from old industries changing their role in the global economy. India's textile sector has existed for decades. It employs over 4.5 crore people and exports to over 100 countries. And yet, most investors, they feel like it's static. Low margin, policy dependent. Nothing really changes. But what if that assumption is about to break? Not because of one budget announcement, not because of one lucky export year, but because three long-term forces are now lining up at the same time. The India-EU trade deal, the India-US tariff, and the domestic policy that finally aligns with the global demand. That's what this video is all about. No stock tips, no quick wins, but understanding whether the India's textile sector is quietly approaching an inflection point and why that matters before we start talking about individual companies. Before we talk about the turning points, we need to ground ourselves in scale. India's textile and apparel market today is estimated at $160 billion, including domestic consumption and exports. That number sounds abstract, so let's translate it. Think of it this way. If India's textile sector was a single listed business, its size would have been nearly double to the market value of global apparel giant Nike, which stands at around $90 billion as of today. So that's not a niche industry, not a side story, but something that already operates at a global scale. And importantly, this market isn't standing still. Industry estimates suggest it could grow to roughly $215 billion over the next decade, driven by higher incomes, changing consumption patterns, and growth beyond the fashion. Because textiles today aren't just about what we wear, they are about what we use. Medical textiles, industrial fabrics, defense application, infrastructure materials, these are the categories where demand grows even when the fashion cycle slows down. About half of India's textile demand is domestic. So this isn't a pure export story. It's tied to India's own consumption growth, urbanization, and manufacturing push. And then there is employment. Textiles employ around 4.5 crore people in India. That single fact explains a lot of policy behavior. When government supports textile, it's not nostalgia or sentimental. It's because very few sectors can absorb labor at this scale while still competing globally. But there is a structural problem underneath all of this. India is still heavily cotton-centric, while global demand has steadily moved towards man-made fibers and technical textiles. And that mismatch is where the next phase begins. So why are people suddenly talking about textiles again? Because in 2026, three big events are aligning, and none of them are short-term triggers. First, the India-EU Free Trade Agreement is expected to reduce tariffs on most Indian textiles and apparel exports from 9 to 12% to nearly 0% over time. And that matters because EU exports over $260 billion worth of textiles and apparel every single year. India's share of that market is still surprisingly small when compared to China, Bangladesh, and Turkey. Not because Indian firms can't produce, but because pricing disadvantages quietly add up over time. When tariffs disappear, the game shifts from who is cheapest on paper to who can deliver at scale, consistently, and compliantly. And that's where the bar rises up. Access to the European market doesn't mean free money. It demands traceability, sustainability, and deeper domestic value addition. Which means companies that invest in better processes and fiber capability don't just gain Europe, they build assets that work globally. Second, the US. In 2025, tariffs on some Indian textile categories climbed up close to 50%, and the recent resets have brought them back to 18% for key products. Let's take an example of a simple cotton t-shirt. If it's exported from India at $10, earlier it faced close to 50% US tariff, pushing the landing price to $15. After the reset, that tariff drops to around 18%, and the same t-shirt lands closer to $12. And that difference alone can decide where global brands place their orders. That swing alone changes everything in export economics. Export volumes to the US, which had slowed or even declined in some quarters, are expected to recover as the price disadvantage narrows. But more importantly, it plugs into a bigger theme: friend-shoring. Global brands aren't just chasing the lowest cost anymore. They're trying to reduce their dependency on single country supply chains. India, with its scale, ecosystem, and political alignment, fits that requirement. When EU access and US diversification happens together, India stops being the alternative to China and starts becoming a core node in global textile supply chains. Third comes domestic policy, which is finally aligning with the global demand. The Union Budget 2026 introduced a national fiber scheme that doesn't just protect cotton but actively pushes man-made fibers and technical textiles. There's also a 10,000 crore rupees growth fund aimed at textile SMEs. This matters because India's textile industry is still fragmented. Capital availability determines who modernizes, who scales, and who gets left behind. Add in extended PLI support and the National Technical Textiles Mission, and you start seeing a pattern. Policy is redirecting the industry toward fewer, larger, and more integrated platforms. And that's not overnight, but directionally. And direction is what long-term investors care about. To understand how this can play out, let's take a look at Vietnam. Vietnam's Europe Union Free Trade Agreement kicked in around August 2020. After that, apparel and footwear exports to the EU rose, with some estimates showing over 50% growth versus the pre-FTA levels. It worked for three simple reasons. First, near-zero tariffs made Vietnamese products cheaper than suppliers without a trade deal. Second, manufacturers changed how they sourced and produced, so more of the value was created inside Vietnam and met EU rules. And third, they became faster and more reliable, which is exactly what European fashion and sportswear brands care about. But it wasn't painless. They saw a rise in wages, rise in environmental compliance cost, and margin came under pressure. The companies that benefited weren't the cheapest ones. They were the ones that adapted fastest. Vietnam's lesson is simple and uncomfortable. Free trade agreements don't reward everyone. They reward the prepared. India's opportunity is larger than Vietnam's because its domestic market and ecosystem depth. But the principle is the same for Indian textile companies. Change your fiber mix, upgrade your processes, integrate deeper into the value chain, or get stuck competing only on price. Now suddenly, textiles stop being a single sector bet and start becoming a business model story. Some companies will benefit disproportionately from man-made fiber exposure, technical textile capability, integrated fiber to fabric operations, and strong compliance and export readiness. Others may see volume growth but margin pressure. So from an investor's perspective, this isn't about chasing headlines in 2026. It's about recognizing that India's EU deal, India-US tariff, and the budget 2026 are all pointing in the same direction. And that doesn't happen often. But when it does, returns don't come evenly across the sector. They come from choosing the right structures within it. So here is the real takeaway. India's textile sector isn't suddenly exciting. It's becoming structurally important again. The opportunity is real. The transition is demanding. And not everyone will make it through in the same shape. So in the next video, we'll talk about how to categorize textile companies, which business models are actually aligned with this shift, and how to think about risk before thinking about returns. If you like understanding why a sector is changing before looking at the stock prices, that's where things get interesting. If you don't want to miss part 2, subscribe to investwithshare.market and hit the bell icon right now.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.